A question many people ask is whether the market actually is going higher in real terms or in nominal terms, and there's a lot of confusion surrounding that issue. So in this chart, what we'll do is take a quick look at the S&P 500 during the period from 1999 all the way through to 2009. And what we see is initially a rise up, then we see the correction due to the tech collapse, and then finally we see the big bull run from 2003 to 2008. And so the question really is, was that bull run a real run? Was it due to organic growth and strong fundamentals, or was it due to some other reason? And which was it? Was it a nominal increase? Was it a real increase? Did people really make money in real terms or nominal terms? And one way of actually identifying whether it was a real rally or a false rally is to identify what happened to the dollars and the dollar market at that same time. And what we see here is that the US dollar actually declined very substantially during that same period. So we have to ask ourselves the question, did the market really rise in real terms? And from this chart, the answer might actually suggest no. Why is that? Well, just as the stock market rose in nominal terms, the US dollar dropped. So if, for example, we found that we had a certain number of shares of a particular stock and they rose during the 2003 to 2008 period, we might think that we had more money. And in practice, we would find that, yes, what we had invested was worth more. But that doesn't necessarily mean that that same amount of money goes as far. And what I mean by that is, if you had, let's say, $100 and it turned into $150, but in 2003, $100 purchased a certain amount of goods or services, and in 2008, $150 went not nearly as far as that $100 a few years earlier, then what we can say is that in nominal terms there was an increase, but in real terms there was not. And that's a very big distinction to make when analyzing the stock market, and it's a very big illusion that we have to see through during that last bull run. It's what many people did not pay attention to. So what people are focusing on right now is the gold market. And what we can see in gold is that there's been a tremendous increase correlating with the downturn in the dollar. We see an upswing in gold over the past decade. Obviously, we've seen a series of higher highs and higher lows. There's no reason to suggest that the gold market is going to collapse anytime soon. It may certainly correct somewhat, but that doesn't necessarily signify a much broader correction. And so nothing really to worry about in the short term if you're a gold bug. But in general, for people who are considering trading, they should be very, very cautious of entering a volatile position such as gold. You can see that the magnitude of the moves in gold are very substantial over very short periods, and not many people have the risk tolerance that is necessary to deal with such substantial moves. So one way of dealing with it is to hedge significantly, and in fact that's what we tend to look at MarketTamer.com. We pay special attention to focusing on what happens if a trade goes against us. And so if you don't know how to do that at this point in time, I would strongly encourage you start to learn how to hedge risk, mitigate some risk, and sleep comfortably at night. And if you're not sure how to do that, there's a group of guys ready to help you out and take you to the next level. So come over to MarketTamer.com. We'll see you soon.